This is honestly scaring the heck out of me, and I don't say that lightly. For the first time in a long time, I'm genuinely worried about my future, because everything is about to change. Not slowly, not eventually. Everything quickly. For years, my job has been to do what most financial professionals do: analyze markets, study price action, interpret data, and try to stay one step ahead. But recently, I saw something that made me realize that people like me may not be needed much longer. A few weeks ago, our parent company, Nasdaq-listed Aether Holdings, called an all-hands meeting. No agenda, no context. Just a message that said everyone needed to be there. In that meeting, the fintech arm of the company revealed a new trading technology they'd been developing quietly behind the scenes. At first, I was skeptical. I've seen plenty of next big things come and go in this industry. But then they showed us the test results, not theoretical models, not back-of-the-napkin math. Real markets, real capital, real trades. And that's when I started to feel uneasy. This system wasn't reacting late or chasing moves. It was identifying opportunities early, sometimes before most analysts or the news media even noticed them. It flagged buying pressure. It highlighted sell zones, and it did it with a level of consistency that made traditional analysis feel slow. Over and over again, it spotted entries and exits more cleanly than most professionals could. That's when the uncomfortable thought crept in. If technology can do this better than humans, what happens to people like me? Now, this isn't a pity story, because the truth is, I don't see this as a threat. I see it as an opportunity. No matter what happens, I still have access to this technology, and I can use it alongside my own research, instead of trying to compete with it. So that's exactly what I've been doing. I still look for strong long-term ideas. I still focus on fundamentals and macro trends. But now, I let the technology help with timing, confirmation, and risk. And that brings me to Hershey. Back in June, we started covering Hershey stock when it was trading around $170 a share. Our thesis was simple. Cocoa prices were collapsing, and lower input costs tend to translate into stronger margins over time. Months later, that thesis started to play out. Morgan Stanley eventually upgraded the stock, raising its price target into the $190 to $210 range. But even that turned out to be conservative. As of this week, Hershey pushed past $225 a share. That's a gain of over 30%, not including dividends. And it didn't happen by accident. As the stock began to move higher, we saw clear signs of continued buying pressure. Institutional interest was building. Momentum was accelerating. At the same time, the technology began flashing alerts that aligned with the move, confirming that this wasn't just retail enthusiasm, but sustained demand. Then, after a sharp run, about 16% in just 5 trading days, the system finally signaled that it was time to take some chips off the table. Not because the story was broken, but because the short-term move had likely gone too far, too fast. That distinction matters. For long-term holders, Hershey still makes sense. It's strong brand, reliable cash flows, a dividend you can actually count on. But for anyone looking to add new exposure, patience matters. The best opportunities tend to come when buying pressure and confirmation line up again, not when emotions are running hot. That's the kind of insight that's difficult to get from headlines alone. Now, Hershey isn't the only example. This past week, one of our traders, Edison, shared several real money trades he executed using the same technology. Some were big winners, some didn't work out, and that's important to say out loud. Nobody wins every trade. But when you look at the net result for the week, the profitable trades totaled over $30,000, not because of luck, because of discipline and consistency. And seeing that made me realize something. Maybe the future of market analysis isn't about who can work harder or stare at charts longer. Maybe it's about who knows how to use the right tools and who knows when to trust them. That's why, oddly enough, I'm not as worried about my future as I was a few weeks ago. Things are changing. There's no question about that. But change doesn't have to mean losing ground. For those who adapt, it can mean gaining an edge. As always, we'll continue breaking down the market, highlighting opportunities, and sharing what we see developing in real time. So if you're new here, welcome. And if you've been reading Alpha Edge Digest for a while, thank you for sticking with us. There's a lot more ahead, and I plan on sharing it all.